The rally seen in the Nigerian stock market in 2023 for the first time in an election year since 2007 is expected to continue into 2024, but at a slower pace. The market finished 2023 with a return of 45.90%, more than double that of 2022 and the highest in 3 years. Investors reaped 13 trillion naira in capital gains as the market capitalization of equities jumped to a record high of 40.92 trillion naira at the end of December. Now, 8 companies had a market value of at least 1 trillion naira at the end of last year, up from 5 in 2022, accounting for about 70% of the total market value of companies on the NGX. The NGX All-Share Index also crossed the 70,000 basis points mark for the first time in November and ended the year at 74,773.77 basis points. From Lagos, Nigeria, Oladipo Ajayi, head fixed income and FX, Chapel Hill Denham Securities, joins me to talk to us extensively about this. Thank you so much for joining us once again, and Happy New Year to you.
Good morning. Thank you very much for having me. Happy New Year to you today.
Now, looking back at the history of Nigeria's equities markets, how significant is the 2023 full-year return of 45.90%? And what does that mean for investors' capital return?
Well, 2023 was an exceptional year when you look around the capital markets. And I think in the recent past, it's only through 2007 that we saw a higher return in the market. That's when the market returned 74.77%. But however, last year was an exceptional year. A lot of people were not expecting that level of return at the beginning of the year. But I think everything took that rate just after the emergence of the new current administration and the balls of the current president to actually make that decisive decision to actually link up subsidy payments and also amortizing the FX window. And I think these two decisions, they are one of the great, they're some of the great catalysts that actually drove the market for last year.
The factors that propelled these results anyway. However, do you expect these factors to continue to equally influence, of course, the market in 2024? Now, before you answer that anyway, we quickly go on a short break, and when we return, we'll consider that particular question, and we hope that you give an answer to it. Oladipo Ajayi, do stay with us. We'll be back. Mr. Oladipo, I'm told that the earpiece is interfering with sound, so the audio quality is poor.
Okay.
So if you can do without them, I think it would be better.
Okay. Let me use the speaker. Can you hear me?
Yes, we can hear you now.
Okay.
Okay, then you may need to tilt your device up a tiny bit. Tilt up.
Up?
Yes.
Okay.
It's too much now. It's too much now. Okay. I think it's fine now, sir. You're watching Business Edge on News Central Television. We have on this past been considering the Nigerian equities market for the year 2024 and what prospect it holds. And of course, we've been talking to Oladipo Ajayi as regards this. Yes, Oladipo, earlier on, we looked at the issue of the factors that are set to be propelling the results that we are seeing, though there's a caveat looking at a slower growth rate. If we were to begin to consider these factors, should we continue to expect them to influence growth for the year 2024? or there are other factors that might come into play?
I think those factors still have impact coming into the new year. But I also agree that there's some other factors that we also need to consider as we speak. One of the reasons why I mentioned that these factors also still have impact into the year is because one, the harmonization of the FX window, we not fully see the full impact of that decision. As we speak, we're not asking the foreign investors actually trooping into our market. So currently, the FX market is still very much illiquid, and so it simply means that in the new year we expect the FX market to be better. We expect the market to be better liquid, and as a result of that, this will be one of the catalysts that will actually draw foreign investors to the market. And we have that belief that when foreign investors come into the market, it will further propel price and valuation of some of these stocks to actually improve than where we are currently trading. As we speak in the market, the mix between the local investor and the foreign investor participation in the market as we speak is more like aside 90% for local investors and just 10% for foreign investors. And we feel that this is not the normal mix that we are used to. We've been in the market where it was more of a foreign investor participation in that market than local investors. But with the current mix now, it simply means that when foreign investors start tripping into the market, we expect prices to actually improve beyond these current levels. And that's why I said that that policy will also still have impact coming into 2024. And also, if you look at the impact of the revenue generation capacity of the government also, we feel that that will also create impact into the new year. We feel that the government will be able to actually embark on a lot of infrastructural projects, which will also help businesses to actually thrive better in the year. And when business thrives better in the year, it simply means that their performance will be better. And also the government has also spoken about minimum wage and also to actually improve the standard of living of workers. And if that is done, it means that the real income of government workers will actually improve. It means that they have more capacity to consume, and as a result of that, companies will also feel the impact, and this will trickle down to the bottom line of most of these companies. And the end goal is that it will also improve their valuation. So this year, we expect to also still see better performance from some of these companies, but not as aggressive as what we saw last year.
Government, as you have mentioned, and the factors that you also brought into perspective, one would have expected that these continued growth would be faster this year. Of course, it would look as though we are testing the patience of investors who would want to commit their funds into the Nigerian market. So don't you think that would be an issue for the investors, most especially for those who may not be patient enough to see growth in an accelerated form?
One of the reasons why I feel that the market may not actually grow aggressively like what we saw last year. Market did about 46% last year, and 46% is actually massive. The market cap was around 27 trillion, and we are now north of 40 trillion. It gives a perspective of what actually happened last year in the market. So coming to the market, most of these stocks are getting more to their valuation levels, and a lot of people are very careful to actually go into the market being very aggressive. We've seen stock like UBA at the beginning of last year trading around 7 naira, and actually traded as high as 22 naira last year. We saw Access Bank actually traded around 8 naira, 10 naira last year, and also traded north of 20 naira last year. We saw stocks like Transport Hotel actually opened the year at 7 naira and also traded around 17 naira. And these are things that is not something that can actually be replicated just immediately in the same quantum coming into this year. We expect some of these instruments to continue to actually improve because of their current valuation. They are still priced below the value of the business. But however, we don't expect them to actually move like what we saw last year. So it simply means that even most of these foreign investors that we're expecting in the market, they will not be so much aggressive coming into the market like that, because they feel that they mixed the boss by not coming in last year. Because a lot of them last year would have been the best time for them to actually jump the market into the market. But missing the box means that they may not get that level of return that they would have enjoyed, assuming they were in the market last year. So for this year, we are still of the view that our market will still trade actively. We are still of the view that market will still bring a lot to the table, but there's still some other things that would actually be like a control to what that view would be. This year, the central bank governor actually mentioned that the H1, they expect the monetary policy guys to continue to be contractionary, be a bit aggressive in actually dealing with liquidity. So it simply means that we may still see more increase in rates beyond where we're currently now. So, and when you start seeing rates actually going above this current level, a lot of people may actually move their funds to more of like safe investment, like treasury bills, like bond, that's actually yielding maybe 20% or not 20% there, rather than still taking their money in the equity markets. So we feel that interest rates increase could also be one of the things that will actually deter that aggressive movement in the equity market. However, we feel that market will improve, but not as much as what we saw last year.
Oladipo, you talked about stocks the other time, and of course we are aware that there are some companies like the Seplat, Zenith Bank, GTCO that are said to be joining what is now known as the SWOOTs, that is the stocks with over 1 trillion capitalization, and that sort of points to the industries that benefited the most from the rally. So there are other sectors of indexes investors should pay attention to in the new year.
Well, I think there's a lot of I think the consumer names, they are segment that investors should actually pay close attention to this into the year. And my view is premised on the fact that
Hello, Oladipo.
Hello?
Okay,
yeah,
yes.
Like I mentioned earlier.
Well, I guess this technical glitch would not allow Oladipo to round up on his summation, but then we appreciate the fact that he came on board to help us understand the Nigerian equities market better at this particular time. I want to say a very big thank you to Oladipo Ajayi, who is the head fixed income and FX Chapel Hill Denham Securities, for his time on the show.